Pankaj Pandey, Head of Research with ICICI Direct, joins us live. Pankaj, morning to you. Thank you for joining us. Pankaj, these are clearly dark days for Indian markets. Irrespective of the global environment, it's been a one-way street for Indian markets. What's your sense? Do you think in the near term, Indian markets will continue to underperform global markets?
Well, Nikunj, it does look like that there are no triggers from the domestic market perspective. If you look at, I think even the current earnings is going to be quite dull and boring. What we are expecting is that the top line growth for our universe would be about 4.7% compared to about 9.5% growth what we have seen in the past 4 quarters. Even for Sensex companies excluding oil and gas and banks, I think the top line growth is about 6.5% and bottom line growth of 5.5%. So if you take this growth and compare to about above 14 multiples which we are trading, I think the earnings are definitely quite subdued, and which is why we really do not see the markets heading anywhere over the next 1 year, at least in terms of upside. I think in case if the growth does not pick up, at least if we don't see any kind of a progressive recovery from here on, the chances of which are quite mute. So in that sense, we are headed slightly lower or probably much lower levels than current levels. So in that sense, I think like I have said earlier also, the upside looks capped, and probably downsides would depend on the kind of growth which will deliver. I think in terms of triggers, probably in case if the crude corrects big time, then that could sort of limit the downside. Or in case if we go in for early elections, I think that would provide some positiveness to the market. Otherwise, I think for the next 8 to 12 months, really not expecting much from the market.
Pankaj, you've got Infi as well slated to come out with its earnings on Friday. Do you think it could turn out to be a market-moving event?
Well, I think if you look at from the defensive side, what we are expecting largely is about double-digit top line and bottom line growth. From the IT, if you look at, we are expecting tier 1 companies to deliver about 2.6 to 3.9% US dollar revenue growth, and Infi would be about 3.9. And if you exclude the lodestone, I think it will be about 2.6, 2.7% kind of a growth. But what would be important is that the Infi guidance would set the tone for the next year, and I think that is where we would look at. I think within defensives, IT is still, though there are no easy money which can be made at current levels, but IT is still better, at least in terms of defensive properties. At least you will not see a big crack in the prices. So in that sense, it is good. Another positive is that if you look at last quarter, the commentary was a lot on how the deal pipeline would shape up. And I think a lot of deals have been signed. So in that sense, that is also one big positive. So in that sense, this year's guidance would have a crucial role. And I think that the entire IT sector is shaping up well, and probably at declines or in case of any kind of crack, one should look at these stocks.
But what if Infosys on 12th morning indicates that in the near term there are multiple challenges and they are not confident of FY14 growth? Will that spook the market? Because bear in mind, Pankaj, most of the IT stocks, at least in one quarter, at least the large ones, they've appreciated by 20% plus. So the majority of the market men, either they own IT or they're hiding in IT.
Well, you're right, Nikunj. I think if you look at from year to date, the IT index itself has delivered about 18% kind of returns. And if you look at TCS would be about 22 times and Infi would be about 17 times. So in that sense, there is no easy money which one can look at. But in case if the company does, because NASSCOM is guiding for about 12 to 14% kind of a growth, and if Infi sort of delivers or sets the tone closer to these range, I don't see a big crack in any of the IT stocks. I think going forward over the next 1 year, I think the challenge is more towards safety because rather than returns, because I don't think we are in a situation where one should be chasing returns big time. I think it is better to be safe. So which is why I think even IT, because last year if you look at TCS actually didn't do anything in terms of price performance, but then you had this year where it has done substantially well. Similarly, we are expecting that the price crack, even in case if the growth turns out to be slightly subdued, will not be much. So in that sense, I think I'm more seeking towards safety rather than returns at this point in time.
Pankaj, let's talk about specifics now. And we can't ignore Maruti for long, can we? On Friday, the stock appreciated by a good solid 90 rupees. What attributed to Friday's rally in Maruti? The fact that they've managed to regain market share to 43%, weakness in yen, or Friday's action was just short covering, nothing more, nothing else. In the near term, there is visible pain for auto stocks, and that will continue. And we should not read much into Friday's price action into Maruti.
I think if you look at from the earnings perspective, I think Maruti would be slightly better placed. But overall auto sector, we are expecting about 2% kind of a top line growth and about 12% kind of a degrowth in the bottom line. But from Maruti's perspective, if you look at it, has got about 28% kind of exposure to yen, about 5.5% in terms of royalty, and the balance in terms of raw material. So if you look at from a sensitivity perspective, if yen were to be at levels of about 100, I think what could happen is that you would see a huge swing in the margins of about 200 to 300 bips for Maruti in terms of EBITDA margins. And also from a bottom line or EPS perspective, I think if this were to get through, I think you would see about 24 to 35% jump in EPS estimates for Maruti. So it is quite sensitive from that perspective. I'm talking of FY14 and FY15 numbers. So in that sense, and if you look at the stock is trading at about 13 times, so which is why I think one can still look at this particular stock. Because besides defensives, I think auto has one good property that you don't have a leverage balance sheet. So in that sense, that is always one positive. So in case if the confidence revives and consumer discretionary spending picks up, I think these are the stocks which one should look at. So Maruti definitely should be looked at, not even from the market share gain perspective, but from the yen perspective as well.
Pankaj, but is it a good idea to buy into a business which will benefit because of currency? I mean, I'll give you a clear example here. Let's look at large cap IT stocks. The rupee has depreciated by 20% in the last 2 or 3 years, but that currency tailwind has not changed the kind of management commentary we've got from large cap IT companies. You buy stocks because you like the business, not because they'll benefit because of a one-time currency adjustment.
Well, you are right. I am not saying that one should really look at from the currency perspective, but also if you look at from the business perspective, like for example, excluding the currency gain, the stock is trading at about 13 times. You would have, at least I think from the earnings growth perspective, you would expect double-digit earnings growth for a stock like Maruti. But for two-wheelers, I think the growth even for Hero MotoCorp or for Bajaj Auto, I think would be in single-digit CAGR. So in that sense, one can look at. In addition to that, if you look at there is a sort of a coolness or the raw material prices are also cooling off, which I think would benefit Maruti in terms of EBITDA margins going forward. So even if you exclude the currency benefit, I think we have been maintaining our target price of 1784, and I think we are just trying to sort of build in sensitivities, but we are really not scaling up the target price because of yen. But yes, it could be a big booster from a short-term perspective.
Pankaj, is there merit in buying ONGC because this is one stock which will benefit directly because of the oil sector reforms?
Well, yes, definitely, Nikunj. I think within oil and gas space, the upstream companies are likely to do well because they share most of the subsidy burden. And if you look at from a valuation perspective, both of them, Oil India and ONGC, would be at about 10 to 11 times forward basis. So in that sense, they definitely make a case for investment. But I think our sense is that probably going forward, Oil India would be slightly better bet because we are expecting the realization for this company to actually improve, and it has got better dividend yields. So in that sense, I think I would prefer that stock. But for the current quarter, I think what we are expecting is that the downstream companies are likely to do well because the government is going to sort of provide them money for this previous spillover of under recovery. So in that sense, the downstream companies are looking from a current quarter perspective. But I think within upstream, I would prefer Oil India more because of slightly better numbers. It is slightly lower, available at slightly lower multiples, and has got a better dividend yield.
Pankaj, is there a special reason why Bank of Baroda is on the receiving side of late? State Bank of India has not seen too much of collateral damage, but Bank of Baroda, BOB, has cracked by a good solid 22% this year.
Well, I think overall PSU banking space, if you look at, I think would continue their struggle on the asset quality front. And Bank of Baroda, after holding ground, is witnessing deterioration in asset quality, and that is likely to continue. In fact, for the entire PSU banking space, if you look at in this particular quarter, what we are expecting is a NI growth of about 8% because this growth will be lower because of the interest reversals which we will see. And on the bottom line side, you would see a degrowth of about 12%. So in that sense, Bob was actually known for asset quality, and now if you are seeing witnesses or a sign of deterioration in asset quality, I think that is what is reflected in the share prices. Contrary, if you look at PNB, which was witnessing slippages of over 5,000 crores every quarter, I think the last quarter the slippages was below 3,000 crores. So in that sense, the stock is slightly better off compared to BOB at this point in time.
Pankaj, a lot of corporates have decided to really delever the balance sheet. DLF, GVK, GMR. Now we understand it will be Aditya Birla Nuvo followed by Arcom. So are you betting on any turnaround candidates for FY14?
Actually not. I think, like I said, I would be in a capital preservation mode. So which is why my preference for sectors would be defenses, which will be IT, pharma and FMCG. And in case if there's some beta which one needs to look at, I think that will be banking and auto. Besides that, I think the investment cycle or the capex theme itself is not working out. And if these players are quite leveraged, I don't think you will see a significant benefit. Say, even for example, for a sugar sector, if you look at the kind of decontrol which we have seen. But if you look at players like Bajaj Hindustan, they have got a debt of about 5,000 odd crores. Renuka has about 7,000 odd crores. I think given all these heavier balance sheets, it is very difficult to take actually any kind of a risk. Like GVK was cheaper at 12.5 rupees, now it is below 10. So in that sense, I mean, you could really see a big crack. So which is why I wouldn't want to sort of bet on any of these heavily leveraged stocks and would prefer to avoid them.